China home sales crashed 53%, threatening to trigger a great financial crisis. I'm your host, Steven Van Metre, and thanks for joining me today. And with China looking to be the epicenter of the next great financial crisis, you might be surprised to find out that the U.S. isn't far behind. Before we kick off the story, tomorrow I'm doing a live stream with Mike Green and Harley Bassman to Simplify Asset Management, and we're going to be talking about, can bonds still shield your portfolio? And as someone who manages a strategy that hedges with bonds, well, this should be pretty interesting, particularly since Harley thinks I'm wrong. I'll put a link in the description below, and you can check that out. I'm sure there'll be a recording. But let's kick off today's story as a Wall Street Journal headline says, property downturn drags on. Chinese developers see an uncertain future, which could be an understatement for today's show. Historic real estate boom is over, says property analyst, and the market could get worse before it gets better. Last week, at least 24 Chinese real estate companies who share trade in Hong Kong failed to file audited financial results for 2021 by a deadline, according to exchange filings. Those developers that managed to do so paint a sober picture of their challenges as new home sales decline, selling prices tumble, and funding remains hard to come by. Bank is one of the developers that have come to the realization that the historic real estate boom that lasted for more than 2 decades is over, and that the market could get worse before it gets better. More than 10 Chinese property firms have defaulted on their dollar debt since last year, and more are likely to come. Now, when you hear about a foreign agency, government, corporation, anybody outside the U.S. defaulting on their dollar debt, this is an indication of a dollar shortage. And this is only going to get worse because the Fed is tightening monetary policy, and that's going to reduce, and that's the goal of it, is to reduce the amount of dollars out in the system. And when you understand that, you realize that when the Fed tightens monetary policy, why we have a recession, because all we're seeing is there's not enough dollars swirling around the global economy for these developers to get the dollars they need to pay on the debts they owe. Let's continue on, because despite government efforts to loosen mortgage lending, remove home purchase restrictions, and lower the down payment ratio for home buyers, China's real estate sector has struggled to recover from a government crackdown on developers' heavy borrowing and a slowing economy. The country's top 100 real estate developers experienced a 53% decline in sales in March from the same month a year ago. Again, year-over-year comp decline of 53%. That is huge, huge. According to data from China Real Estate Information Corp, it marked the 9th consecutive month of declines and the steepest for the industry since the downturn began last summer, and again, makes you think another financial crisis is imminent. The developers that missed the deadline to file their annual reports said that COVID-19 restrictions were a reason for the delay, and whose liquidity troubles have mounted in recent months. Auditors have resigned from multiple developers, leading some of them to release unaudited results to avoid share trading suspensions. And of course, you know when auditors resign from auditing that companies are cooking the books. And again, you go back to the great financial crisis and you see some of these things happening. Slowdown in sales, reduction in credit. And all of a sudden auditors are going, whoa, I don't want to touch that with a 10-foot pole. And you get the idea that what's going on in China could have massive repercussions for the global economy. And the slowdown shows no signs of abating. In the first 3 months of this year, the volume of land sales in 300 Chinese cities dropped 60% from the same period in 2021, and only 30% of the top 100 real estate companies acquired land. The decline means developers will have fewer new projects to sell in the future. And according to government statistics, China's housing market has cooled from its hot gains of the years past, but is still taking along. The average new home price rose 1.7% year over year in January and 1.2% in February. But wait till you see the non-government statistics. Yet financial filings, marketing materials for apartments, property agents, and analysts tell a different story. Debt-burdened developers are selling apartments at falling prices, and in some cases providing big discounts to get cash in the door. And industry giant Country Garden, one of China's financially stronger developers, reported a 14% decline in its average selling price in January and February from the same months in 2021. A mid-sized developer, Logan Group, said its average selling price tumbled close to 40% year over year in the first 2 months of 2022. And earlier this month, Soho China, developer of mixed-use commercial and residential buildings, said it will sell 9 projects in Beijing and Shanghai at a 30% discount and use all the proceeds to pay off its debts. And of course, that doesn't sound like a healthy housing market. It sounds like the ship is sinking quick and everyone's looking to get bailed out. Now, if you're concerned that your portfolio is about to go deep six into the next great financial crisis triggered by a blow up in the China housing market, well, be sure to click on Portfolio Shield. I'll put a link up there in the corner in the description below. Be glad you did, because it's one of the few strategies out there that when the yield curve steepens, it knows what to do. Now let's take a look at the U.S. housing market, because what we're seeing now are indicators that everybody is bailing out at the wrong time. Not in the housing market, but in terms of how their portfolio is running. So if people are in conservative portfolios or have bond heavy allocations, they're running right now. They're heading to cash, they're heading to equities, and they don't realize that the U.S. housing market is not far behind what's going on in China. And that's actually really bond bullish. Let me check this out. We see the 30-year mortgage rates rising to 5.13%, cresting the 5% number. That's going to have a massive slowdown in demand. And we see that as mortgage applications continue their slide down 1.3%. But the big one is not the purchase index. And you can see it's relatively small, about a fifth the size of the refinance index. And the refinance index continues to slide. Just how bad is things in the refinance world? Well, if you work in the mortgage industry, you already know, because the odds are you're going to see layoffs coming, or you already know that this is coming because you're seeing it coming down from the top, where companies are talking and looking to lay off people. The demand just isn't there, and that's how the industry works. It's feast or famine, and right now it's headed toward famine, and that means a lot of layoffs. But look back, and I want you to see just how bad this refinance index is. It's getting down just over about 1,100 right now, headed down to some lows that we haven't seen around 900 since 2019. In fact, these last time we got down to this 1,100 level was around 2014. And what does that mean for interest rates? Well, everybody is convinced interest rates rise, and that's why you're seeing, even again, a lot of conservative investors are ditching their portfolios. They're just going other directions. They're cramming into equities, and this happens when the yield curve inverts. This is very common. You see rates go up some. Now they've gone up more than other times, but look what's about to happen. And I want you to see why investors get this wrong every time. Rather than just holding their positions and letting the curve steepen, they bail and miss out on what's coming for them. Here you can go back to 2014, and what you see is mortgage rates went down because applications dried up. And what happens? The rates have to go down. Then you see it again here in 2019. Applications hit on the refinance index around 900, and boom, rates went down. And it makes perfect sense because banks get big problems from this. And here we can see from the JP Morgan earnings today, in home lending originations of $25 billion were down 37%, primarily due to the rising rate environment. And perhaps the biggest red flag here is that retail mortgage origination was down $15.1 billion in the first quarter, which is 33% less than fourth quarter and 34% less than a year ago, a pretty significant slowdown. And you think about how banks make money by lending, and yes, we see credit card data is up, but they don't make a lot of money on credit cards. They do in volume, but in terms of compared to the mortgage market, which is a behemoth in this industry, they make a ton of money on originations. Whether you even pay that or not, it's backed into the loan somehow. And I guarantee you it's big money for the banks. And at a time they'd like to lend, but at these rates, no one wants to borrow. And that's how you know rates are coming down. But again, most investors don't realize that at all. And adding further to the story of the U.S. housing market as lumber falls to fresh 2022 lows, a spike in mortgage rates cools housing demand, and inflation puts dent in home renovations. And what this does is it puts pressure on banks to buy bonds and drive down rates. And that means when rates go down, bond prices go up. And when financial crises happen, well, flight to safety also drives rates down and bond prices up. And now you understand why investors get this wrong every time. I'm Steve Van Metre. Appreciate you watching. Appreciate you being fans. Bye now.